Hello everyone, how you doing? You are welcome to video 16. So as you can see to the upper left of my screen, today I'm going to be talking about introduction to institutional candles, types of institutional candles, what is a mitigation candle, how to spot a mitigation candle, and how to trade a mitigation candle rather. And I'm going to be showing you where to put your entry, where your stop loss is going to be, and where your take profits is going to be. And then at the end of this session, I'm going to give you an homework exercise, which you will be required to do. Send to me before you proceed to video 17. So again, today we are going to be looking at introduction on this call. We will be looking at introduction to institutional candles, types of institutional candles, what is a mitigation candle, what what is a mitigation candle, how to spot a mitigation candle, and then how to trade a mitigation candle. So I'm gonna be telling you what a mitigation candle is. I'm gonna be showing you how to spot it, and then after showing you, I'm then gonna show you how to trade it. Right? And how do you trade it? What I'm trying to say is, where's your entry gonna be? Where's the stop loss gonna be? And where is your take profit going to be? Right? Because it is very important when we are trading as smart money traders, as traders generally, it is very important to make sure you have stop losses on your trade. I never go in on trades without having a stop loss. So my stop loss is always defined. That is one of the major reasons why I do not have, I do not go on trades with market execution. I do not use market executions on my trade. I don't do it. Because why I don't do market execution is because number one, I'm not gonna know the right amount of lot size to use immediately because I don't use a fixed lot size per trade. My stop loss determine my lot sizes. Exactly. So I'm believing that you watching video 16, you have actually watched the video before this because the video before this, there was when I was discussing video 6, right? I didn't finish video 6. I only talked about peep, pipet, and lot, and I didn't talk about the leverage. So after video 6, I did video 7 all the way to video 15. Then I remembered I did not complete video 6. I didn't talk about leverage. So I actually made a video on leverage and how to understand leverage and what to, you know, how to just, I talked about leverage, right? And then there's no way I can put it up again. So I had to upload the video after video 15. So I'm believing that when you watch video 6, you're going to go to the video after 15. That's video 6 continuation. Watch the video on leverage, then move to video 7. Okay, please, I want you to do that. Okay, so I'm believing that before this video 16 video you're watching now, the video you watched before that is video 15. If you are watching video 6 before this video 16, it means you did not continue or you did not finish video 6 when you were at video 6. Okay, so please, from video 6, continue the remaining part of the video 6 down, then you move to video 7, and then all the way to 15, and then this one, video 16, right? So also, I want to take a break and ask you, I want to use this moment to ask you, how has the learning process been? Have you been learning? Have you been acquiring knowledge? Right, you paid quite a huge amount of money. Right. I will say it's quite a big amount, right? So I hope you are seeing the value in all what you have been learning so far, right? This is just video 16. There's still a lot of videos you're still going to watch from me, right? So I'm bringing all the things I've learned over the years and I'm making a very detailed course, right? So please give me your feedback after you watch this video. Give me your feedback, write me a message, let me know how it has been for you. All right. Thank you so much for doing that. I'm going to believe you're going to do it. So thank you so much for doing that. All right. So today we are going to be looking at introduction to institutional candle. What is an institutional candle? That's it. What is an institutional candle? So, like I always love to do it. Let's head over to Google and then we just and then we type, I've done it already. What is institutional candle? So what is an institutional candle in Forex? So look at the definition we got. Oh, sorry about that. Let me bring this up again. All right, so just gonna bring this up here and you can see. So the definition according to Pinterest says the institutional candle is the last opposing one or multiple close candles before a strong directional move. It is also called banker's candle, right? So again, the institutional candle is the last opposing one or multiple close candles before a strong directional move. So the key word there is last opposing before a strong directional move. So what this is saying is that there is an inverse relationship between the candle and then the candle that is going to print next. So if the candle that is printing is a bearish candle, then the next candle that's going to print is going to be a bullish candle. Right, that is what this definition is trying to tell us. Right, the institutional candle is the last opposing candle. Are you catching it now? Last opposing candle in last opposing one or multiple candle close sorry, the institutional candle is the last opposing one or multiple close candles before a strong directional move. Okay, it is also called a banker's candle. So this is what the definition is given to us for what an institutional candle is. Now we have different definitions of an institutional candle. The Forex market is very wild, like it's very wide. There's a lot of trade. We have a lot of traders that are trading in the financial market, different people coming up with different definitions, different people coming up with different meanings, right? So there is no one perfect definition to what an institutional candle is. Different people come up with different definitions as to what it is, right? So now, but then we all have, if you look at it, there's something in common. Like we're all talking about the candle, and it's trying to say a candle in one direction, then price move in the opposite direction, right? Like this definition, what this definition is saying is that the institutional candle is the last opposing one or multiple close candle before a strong directional move. If I'm to have like a chart illustration of what that definition is saying, the definition is saying we're going to have a candle in this direction, like a candle in one direction, opposing direction. So we can make this red, and then that is price giving us red, and then the next candle that's going to print is going to be a big candle in the opposite direction. So this red candle is the institutional candle according to what this definition is saying. Let's take it again. The institutional candle is the last opposing one, close candle before a strong directional move. So this is a strong move to the upside. This is the last candle before the up move. Now, I know over the years, I've seen different traders say institutional candle is the last up candle before the down move, the last down candle before the up move, right? No. Okay, I am not agreeing to that definition of what an institutional candle is. Because if you settle with that definition, if you agree with that definition and you want to trade that way, it means you're gonna be taking every last sell candle before the up move and every up candle before the down move. Right. But no, that is not how I see institutional candle. And that is not how I'm going to teach you. I don't want you to see it that way. So I'm not saying it's wrong, but that's their own way of trading. So let's respect them and let's come up with our own, right? So no, we're not gonna go with that way. It's like every last sell candle before the up move, every last buy candle for the down move, So no. All right. So now what do I, if I'm going to introduce institutional candle to you, I think the first thing I need to let you know is that institutional candles are bank candles. Okay, institutional candles are bank candles. right? Remember when we were talking about smart money, I explained to you, I showed you the top 10 currency traders, right? I strongly believe that people move price. I do not belong to the school of thought that it is computers or a logarithm that move price. It might be correct, but then I've not seen it. The way I learned it from a mentor is that people actually move this market. Somebody can come and say, okay, I'm shorting EU. EU is going down today. Or for the next 2 weeks, EU is going down. So I believe that people actually move price, not some random computer or something. Might be possible. I'm saying it again, but then this is what I choose to believe. At the end of the day, it doesn't matter what we believe, right? So the most important thing is we have a strategy that is working and we are making money from it, right? So it meets people arguing, oh, market moves with a logarithm. Some said market move with by people move price and they are all head to head with each other. It's of no use. The most important thing is we're making money, right? So, so who cares? Exactly. Right. So institutional candles are bank candles. Let me write that down now. Okay. Institutional are bank candles. Institutional candles are bank candles. Now, when we say bank candles, what do we mean? So, like I was saying, I've explained to you what who smart money is, right? And then you know now that these top 10 currency traders are the people we refer to as smart money because they have a lot of money to push price and manipulate the market. And I showed you in the video, one of the videos before this one, where these institutions were being fined some, they were being the court asked them to pay some money because I think I cannot actually remember how we went, but then they were charged and they had to pay some fines for manipulating the market. So this is proof that these people actually manipulate the market to their favor, right? So if every candle, we know that the candle, this the Forex candle, the buy and sell candle you see is as a result of demand and supply in the market, right? So if the candle is buying up, that is showing the presence of demand, more buyers, right? If the candle is selling down, that is evidence that there's more sales. But now we have buyers and sellers like head to head with each other, and that is what is creating these candles. Now, institutional candles are bank candles. Now, we retail traders, do we have what it takes to move price? Definitely, the answer is a big no. Okay, we retail traders, we do not have what it takes to move price. Be it 5K account, be it a $10,000 account, be it a $20,000 account, be it $200,000 account, be it $1 million account. We still do not have what it takes to move price. In order to move price by one pip takes a very big amount of money. So if we do not have that amount of money, so who then is moving price? So how come price, if we come to Euro USD chart now, it is moving. So who is moving it? So I believe that the institutions are the one moving this price. And we retail traders, because we cannot move price, all we can do is to analyze the chart to be on the right side with the institutions and then take price and hope that the institutions will move price in our favor. That's how we make profits. We don't make profit because we buy and price just because of what we clicked the buy and then price just moved because of our money we placed. I mean, moving price with $50, moving price with $100 is that, I don't think that's possible. Not even think it is not possible. Definitely not possible, right? So how come you place a buy and then you see price start to go in your way? It is not you or me that is moving that price, right? Or that asset. It is the institutions that are moving price and they need a big amount of money, which they have in order to move price. So every candle that is being printed is printed by the institutions. Every candle that you're seeing on your chart presently now is a bank candle. So if all the candles are bank candles, how then do we now look for the ones to trade? Because the way we trade, the way I trade, the way I'm teaching you to trade, I'm teaching you to trade in a way that you do not need any indicators on your chart. Number one. Number two, I'm teaching you how to the way I'm putting you through on how to trade is so you can open up your charts, look at the candles, and be able to tell what has happened, what is happening, and what is going to happen. That's it. That's how we make money. That is how we make money. I don't think there's any other way we can make money in this market by not predicting what is going to happen before it happens. That's how we make money. So if I'm buying Euro USD because I'm believing that it is going to go up even before it happens, that's why I'm getting in on the buy. If I'm selling, it's because I believe price is going to drop. So I'm me being able to predict what is going to happen in the next seconds, the next minute, next hour, the next day. That's how we make money. Or should I say that's the only way we make money in the Forex market, by predicting what has happened. And how do we know what is going to happen? So you need to be in a position where you've already understood what has happened. Then you look at the candles again to tell what is happening. Are you with me now? And then knowing what has happened plus what is happening, you can now be able to tell what is going to happen. Are you seeing it now? That's it. That's it. So institutional candles are bank candles. Every candle you see on the chart is a bank candle. But now, these same institutional candles are trade idea candles. Because if I'm going to be buying, I'm going to be selling, the way I trade, I'm going to be buying off or selling off a particular candle. Or my buy reasons or sell reason is going to be based on a particular candle. So if every candle now, if every institutional candle is a bank candle, meaning every candle on the chart is a bank candle, does that mean I'm going to be trading every candle? No. So that brings us to the next point that says not, how do I put this now? Not every institutional candle. Okay, yeah, that's it. Every, not every institutional candle is a uh is a trade idea candle. Okay, but every trade idea candle is an sorry, NSTI is an institutional candle. So yeah, so not every institutional candle is a trade idea candle, but every trade idea candle is an institutional candle. So what I'm trying to say is that a trade, like a trade idea candle, is definitely a subset of institutional candle. Because if you don't understand mathematics, you know what a subset is, right? That's it. It's inside, right? Maybe we do the Venn diagram, right? You remember the mathematics, right? The Venn diagram, and we have this inside, so like the subsets. Okay, so it's just like saying, there's this common example they used to give to us when we were still I mean in secondary school level when we're doing sets. Starts to with alphabet, right? And then they can say vowels. We have Z vowels now, A, E, I, O, U, right? And then the every vowel is inside the alphabet, right? Because the alphabet is A, B, C to Z, right? So you can also pick, so the vowels is a subset of the alphabet because it will get all the vowels inside the alphabet, And then I think you have consonants. I can't even actually remember what it is, but the ones that are not vowels, right? So I cannot actually really remember uh what it is. Okay. But then you understand my point, right? So not every institutional candle is a trade idea candle, but every trade idea candle is an institutional candle. That is it. Okay. So now I've been able to talk, explain to you or give you an introduction to what an institutional candle is. So forget the definition I just showed you. That is not how you're going to be trading. You're not going to be trading every last sell candle before the up move or every up candle before the down move. No. Okay. There are specific institutional candles I like to trade, and there are only three in number. That's the three have been trading and I will continue to trade, except maybe maybe I do my research and find a new one. But so far, there are three types of institutional candles. So I want you to understand first that institutional candles are bank candles. Okay, institutional candles are candles representing the movement of price caused by the institutions, right? And all these candles are actually bank candles because we cannot move price. So there's no retail candle here because we do not have what it takes to move price. So if you see price move from one point to another point, that is an institutional candle. So every candle you're seeing is an institutional candle. But then what differentiates it is that not every trade idea candle, I'm sorry, not every institutional candle is a trade idea candle. So in as much as every candle is an institutional candle, it is not every of that candle that we are going to be trading. Okay, so now the next question is, so how do I know what candle to trade? How do I know what institutional candle to trade? That brings us to the next thing I'm going to be talking about is types of institutional candle. So we do have three types of institutional candle. So there are three types of institutional candle. There are three types of institutional candle. Okay, number one is institutional in form of a mitigation or mitigation candle. That's number one. Number two is institutional candle in the form of, let me quickly see so I can know what topic 17 is going to be. Just give me a second. Okay, yes. So institutional candle in the form of an imbalance. Okay, in the form as an in the form of an imbalance candle. Okay, we can put that also as candle. And number three is institutional candle in the form of in the form of a smart money cube. Okay, so we can call that smart money cube candle. Exactly. I mean, each of these three have other names we can call them, but then these are the three types of institutional candle. So institutional candle in the form of a mitigation candle, institutional candle in the form of an imbalance, institutional candle in the form of a smart money cube candle. All right. So you see it now? Not every institutional candle is a trade idea candle. Every candle you see on your chart is an institutional candle, but not every candle is a mitigation candle. Not every candle is an imbalance candle. Not every candle is a smart money cube candle. So these three things is what differentiates all the candles, like is what differentiate the institutional trade idea candles from the other institutional candles we have. Every candle, I'm saying it again, every candle is an institutional candle. But then these are the three specific type of candle I want you to be on the lookout for anytime you want to take a trade. Because taking your trade revolves around these three type of institutional candle. So you can either take your trade based off the mitigation candle, or you take your trade based off the imbalance candle, or you take your trade based off the smart money cube candle. All right. So these are the types of institutional candle. I don't know if there is a fourth one. I don't know. I've not heard of it. So maybe there might be somebody somewhere that's come up with a fourth type of institutional candle. But then this is how I learned it from my mentors. And this is how I'm passing it on to you, my mentees. All right. So yeah. So that takes us to the next subtopic. As you can see, what is a mitigation candle? That's it. What is a mitigation candle? Mitigation. Mitigation. So I think the first thing we need to first look out for is what is mitigation? That's it. So we can head over to Google again. Google is our best friend, right? So what is mitigation in Forex? So let's see the definition. Okay, let's see. So according to, this is Forex Academy, right, 17 March 2023. So this is the definition was uh, live on Google this year, March 17. So it says, mitigation in Forex trading refers to the process of reducing the potential risk associated with trading in the foreign exchange market. Mitigation strategies are used to minimize the potential losses and improve the overall performance of a trader's portfolio. Again, mitigation in Forex trading refers to the process of reducing the potential risks associated with trading in the foreign exchange market. So what the keyword I want you to take out is the process of reducing potential risk. And when they say when we say like risk associated with trading, that is money, right? You want to try to reduce your risk as possible. Or when as I'm explaining, you will see what I'm talking about. But just keep this at the back of your mind, okay? Process of reducing the potential risk associated with trading in the foreign exchange market. Mitigation strategies are used to minimize the potential losses and improve the overall performance of a trader's portfolio. That is it. That's what a mitigation is. Now, according to the definition we saw on Google now. But now, if I am to give you what I understand by mitigation, right? I'm going to give you a very simple definition, not something so complex, something very easy for you to remember, right? What is a mitigation candle? Or what is mitigation? The way I understand mitigation, the way I have seen my mentors teach mitigation when I was learning under them, right? Because I had quite a number of mentors, right? A lot of them, many in the United States, right? Each of them coming up, like they all have their own unique way of trading. We are all trading smart money, they're all trading smart money concept, but then they have their own unique way of getting in trades, buying and selling. They have their own unique way, right? And then I hear them talk about mitigation, 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 and mitigation. Right. So the way I understand mitigation to be, because I remember one morning when I joined Rock Kuma. So Rock Kuma used to do the pre-London session. That's pre-London markets. Before London opens, right? We used to have a call so we can look for our pre-London session analysis, right? And then there was this trade we wanted to take, right? And then it was about, I think about 15 minutes to London open, right? And then we were live. It was live in channel. So I just opt in, log in, and went straight, I attended the session. I was live also, and I was actually teaching with somebody else, and then they called out the trade for us. And then the person was, I cannot really remember who the guest was, but then it was like, let's look to buy this particular asset now, because price before London session already came to mitigate. So mitigation happened right few minutes before London session for a buy. So we're looking to buy, price sold down, mitigate, and then price immediately was London open. We started to see higher pricing for price. I can remember that day I made some money. So I really remember that day. Right. And then I was like, what is mitigation? What is mitigation? I want to learn more about mitigation. Right. And then I just started to learn. Like I told you, I signed up to I Am Academy because I wanted to learn how to trade. Um I wasn't too active with the signal aspect of I Am Academy. I was just there for the learning. I wanted to really know how to do this myself. Because I don't want to be paying $187 every month. So my plan was to pay it till I'm okay. I can trade myself and then I stop paying. That's it. I don't want to pay $187 every month because if I'm focusing only on the signal, then I'm going to be relying on these people to give me trades. And the days when they are not available, I don't take any trades, right? So I was of the opinion that I want to learn how to trade. I want to know how to trade. And then they have their videos. I could go and watch their past recordings, which was very, very amazing, right? So I went to some of their old videos, started watching, and just combined all the knowledge together. And they were all saying the same thing, but in a different form. That's it. Just like how if I want to get 10, there's many ways to arrive at 10. I can add 9 plus 1, I can get 10. I can add 5 plus 5, I can get 10. I can do 100 minus 90 is going to give me 10. There is so many ways to arrive at 10, right? But then the procedure might be different, but we are all arriving at the same answer. That is what it is with the educators in IM Academy that teach smart money. They may have different approach, but then they're all trying to say the same thing. Right, exactly. So mitigation, the way I understand mitigation to be is that I'm going to give you an illustration to define what mitigation is. So follow me now. Okay, we are all buying. Okay, we are all buying at a particular area. Remember, if we're buying, all our stop losses go where below. Remember when I was teaching you liquidity, when we talked about static liquidity, everybody buying is static in a static area have the stop losses below. So we are all buying and then stop losses are being built below. I told you in the call that um, there are reasons why institutions will stall price at a particular area because they're trying to induce retail traders to believe that that is a support level. And then people are getting in, people are buying, and then price will just dump down. And then instead of price to go up, we see price just go down, sell past the support. Why is that happening? That is the institutions taking out liquidity. That is the institutions taking our money. Because remember, I told you in liquidity that liquidity equals to stop loss equals to money. If you have forgotten what I just said now, you need to go back to video 15 again. Everything I'm teaching you, everything you're going to be learning is all interrelated. If you want to learn how I trade, if you want to mark up the charts the way I do, if you want to be able to call out these entries the way I do, then you should not study one of the video and forget everything I've said in the video and just come with a blank head with the next and watch the next video. Everything it is like a chain. Everything I'm teaching you is like a puzzle. You need every piece of it in order to complete the puzzle, right? You need every piece of it to complete the puzzle. Just like I can do A now. If I write letter A consists of, from what I'm seeing here, letter A consists of 3 lines. 3 lines makes up A. I can draw the first line, you can draw the second line, you can draw the third line. So if you do away with the first one, you will never get an A. This, what does this look like? This looks like more like an what's that thing? In case we omit something in English, you will just put it and then you put the word on top, right? Definitely. So this is not an A. So you need every of the line to give you an A. That's what all what you're learning from me is. You want to be able to combine everything together in order to arrive at a meaningful conclusion. All right. So if you've forgotten what I just said about liquidity, go back to it and watch the video. So I'm going to continue now. Okay. So where did I stop just now? I just forgot. Yeah, exactly. So I was talking about mitigation candle. So we are all buying, remember the static liquidity example, and then price just go past the support. And then price takes out the liquidity. That's the institution is now taking out liquidity, and then price rejects and go up in our direction. What has happened is that the institutions have taken out the holders that are there, and then they got in at a better entry and took price all the way to the upside. Seeing it now? So what that means is that the way I understand it again, coming from a place where, like, what I'm trying to say is the way I learned it, right, is that the sell down is more like a fake entry for the institutions. The sell down to capture the liquidity just to buy back up again with a very big position size. And then the take price all the way to the upside. So the way I see it, just coming up with an illustration for what it is, right? So the way I learned it, right? And I would say this quickly is that, like I said, it works. We might not really get the definition or what is happening, but from the way we see it and how it has been working, is that price sell, the institution take price down. For price to go down, definitely somebody needs to sell, right? And then they sell past the liquidity and then buy back all the way back to the upside. And then we've seen this happen countless number of times when price come back to the open of 50% and then price reject from there and go all the way to the upside. So because that has happened, I'm sure that's why they came up with a theory around it and called that candle, that particular candle, a mitigation candle. And when you see that mitigation candle, you want to be able, once you spot it, you have your trade already. Your trade is already setting up. Then you want to add some little things, structure, every other thing you want to add the structure. Remember, I've taught you market structure. So you want to be able to have that. And the checklist, remember the checklist I showed you. The first thing in the checklist is the structure. The next thing is the range, right? Then the third thing is the Fibonacci, right? And then after the Fibonacci to the 14 is the uh no the market. Number one is the market the trend. Number two is the market range. Number three is the Fib. Number four is, oh, I'm mixing it all up now. Okay, I'm coming. Just let me quickly check because I'm beginning to mix it all up. I mean, it's okay for me to forget at some time, at some point, right? Okay, checklist for trading. I've seen it now. Let me just pull it. Number one is the trend of the market. Number two is the range of the present market. Number three is the Fibonacci. Number four is the liquidity. Number five is the institutional candle. So the way I sent out or the way I'm dropping the videos, I think I made the video first on market trend, and then I talked about market range. I've not spoken on Fibonacci. I've already explained liquidity to you. Now I'm talking about institutional candle. After institutional candle, then I'll talk on the Fib, and then we can now look at everything together, bringing it all up, all together. Exactly. So mitigation, that's the first thing mitigation can. So I just gave you an illustration of what a mitigation candle is. Let me give you a chart, a candle illustration of what mitigation candle is. All right. So the first thing I want to do is let us draw something like this. Okay. So we're going to have this. So that's going to be like the support. And then we're going to have some candles. Just let me quickly draw one. Okay, just yeah, something like that. So I'm just gonna be fast with it. Okay, exactly. So let's take this down a little for now. Um, I just want to give you a fast illustration of what I'm talking about. Okay, so we have this candle, there's a bullish candle, right? And then we have another candle. This also is a bullish candle. Okay, if this is a bullish candle, that means it's starting. No, let's say this is a bearish candle. So down here, let's make this longer. Just want to give you an hypothetical example of what I'm talking about. We can have this as red. Okay, price so down. And then the next candle, let's just make it 4 so we can be first. So price is going to buy up from that area and then price buy all the way to the upside. And just make that green. Also, price has this. And we have this. So we have the bullish candle, the bearish candle, the bullish candle. And let's say we have now another bullish candle in this area. So something like this. And then we have this. Okay. Oh no, let me make this a bearish candle. All right, so we have this now has the bearish candle plus the wick to the upside. Definitely. So I'm just gonna make this so yeah. So now what can we see with all of this low here? All of this low is this is a static liquidity. You know this already, right? That this is a static liquidity. People buying this stop losses are going to be way below. So now we know that this is liquidity. What type of liquidity is this? I've explained to you. This is a static liquidity, right? So now the concept of mitigation comes now. This is what happens. This is how you can understand mitigation. So I'm going to be like, what is mitigation? What is a mitigation can do? I've explained that to you. And then how to spot a mitigation candle. That's what I'm drawing now. That's what I'm about to show you, right? How to spot a mitigation candle. Okay, so now the first thing we see all of these candles, prices creating liquidity to the downside. So we can call this liquidity. Okay, so what type of liquidity is this? What type of liquidity is this? This is a static liquidity, right? So I'm just going to leave that as liquidity. And now the next candle that opens, let's say is the next candle is also a bearish candle. Okay, I said the next candle also is a bearish candle. I'm just going to start from here, right? So next candle is a bearish candle, and then the candle sold down. The candle sold down. At some point, the candle was selling, 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 and then sold down, right? Took out the liquidity. Okay, candle was selling, took out the liquidity. Just see this now. Okay, was selling, took out the liquidity, right? And then price started to reject, and then reject, and then price stopped here. And then price closed. Now, what has happened in this area? This is the institutions now in this area. This area here, the institutions now have sold down to capture the liquidity that is resting in this area. Because now you can see we had a very big run on the liquidity. So that means whoever was buying in this area. Now they bought because they believe that the price is going to go up. Remember, if we buy, it's because we are anticipating, also believing that price is going to go up in our favor. So whoever is buying here now is believing that price is going to go up. But now price sold down first. If they had a stop loss down here, this candle down would have taken it. Those that have the stop loss and break even, price would have taken it also. And then what we see next is that we see a bullish candle. Is that we see a bullish candle now. And now the buy they were anticipating now happened. See it now? Exactly. We can just bring this to the front. Let me bring in the horizontal ray. Let's put that there and then close this. Exactly. So we see it now. Is it? Price is still buying all the way to the upside. Now, in this area now, how do you spot the mitigation candle? The mitigation candle is a candle that takes out traders. Mitigation candle is a candle that runs on liquidity. A mitigation candle is a candle that captures stop losses. A mitigation candle is a candle that goes below the support. Are you seeing it now? This area here, to some people, this is a strong support area. We as smart money traders, we don't see this as support, we see this as liquidity. See it now? This is not how we are going to identify our own support. I'm going to be teaching you the concept of the way I use demand and supply also. I don't use it the normal way people use it, right? I'm going to show you how you can have the concept of demand and supply as a confluence to your trade, right? As you can have that as one of your checklists, maybe checklist number 6, demand supply zones. But in this area now, the mitigation candle is this bearish candle. Remember the definition I showed you from Google. It says the last opposing candle before a strong price movement in one direction. So we can still agree that that is an institutional candle. But I'm not going to call that alone an institutional candle. It is a subset of an institutional candle, because institutional candle to me is divided into 3. So what is the real name? This candle is an institutional candle. But what actually is the name of this candle now? This is a mitigation candle. Because like I said, somebody sold this down to run this liquidity. And then price rejected, and we saw a big price direction to the upside. So if that happens, definitely whoever is selling this most likely is in drawdown. That's the way I learned it, right? Is in drawdown. So price needs to come back in order for whoever sold this down to close that trade at break even. So now, if you have the opportunity, if you can move price, if you have what it takes to move price in your favor, would you do it or not? That's a question for you now. If you have the opportunity to move price the way you want, don't you think you will do it? Of course I will, right? I will, right? So now price sold down here. Let's say the institutions got in here. They sold down in this area. This is where they sold. This is where they took the sell from. And then they captured this liquidity down here. And then they bought down in this area here. So this is now, you can see, just this alone tells you that the institutions like to buy below support because they believe that there is liquidity in that support area. They're going to take price down below the support and then get in and then push price all the way to the upside. So they are selling here to buy down here, right? So you see, they sold down to buy. As soon as the next candle opens and price starts to buy, the moment price can go above this sell area because they took the sell from 0.88250. The moment price can go past 0.88250, this sell position is most likely in what? In drawdown. And what do I mean by drawdown? They are running a negative on that sell trade. So I'm asking you again, if you have what it takes to move price in your direction, if you have what it takes to push price to come back to your entry because you don't want to close that trade at a loss, if you have what it takes to do it, will you do it or not? That's a question for you to answer. Definitely for me, I'm going to answer for myself. I will do it because I don't want to close this trade at a loss. Because the moment this continues to buy up, I'm most likely in a drawdown. That's how I'm saying it. That's the way I'm reading it. I could be wrong. I mean, I learned this from my mentors. They could be wrong, right? But the idea, the way we might be explaining it might be different, but the destination is the same. We are looking at this candle to take a trade from because this candle many a times presents trading opportunities. Now, the theory behind it might be wrong. Somebody somewhere can come up with a different theory as to why this is happening. We all can have our own definition as to how we see the market. The most important thing I'm saying again is that we are making profit from a strategy. We are not learning all of these things because we want to write an exam. No. So who cares? Right? Exactly. So now price bought all the way to the upside. So we are expecting price to come back to at least the open of this area here. So this area where the sell started, I'm going to be expecting price to come back down to this area. The moment price can come back down to this area, so what I want you to see it as the sold down here to buy down here. The moment price can cross this 0.88250, this sell position is in a loss. Now, in order to close this sell back in profit or at zero, what do you think needs to happen? A simple mathematics. Whatever the price number is, it needs to come back down to where this sell started. See, so if you sold at 0.88250, price is at 0.91362. In order for you to close this trade back in break even means zero, or close it in profit, price needs to sell back down one way or the other to 0.88250. So now the idea and the theory that came around this is that the same person that sold down here most likely bought here, and the person is in two positions, and then we need price to come back down to close that sell order because the sell was a fake trade. They just sold down to capture the liquidity because they originally wanted to buy, but they did not want majority of the traders to be with them. So they took price down, clear everybody out, and then they got in, and then price is going up. Remember, I told you every candle is an institutional candle, is a bank candle. Every institutional candle is a bank candle. Seeing this big movement. See this big number, this big movement, this big candle, this big body candle. Only the banks can do this. I can't do it. You can't do it. Only the banks can do it. Big hedge funds can do this, right? It's a price bought up. So we need price to come back down now for mitigation. So this is the concept around mitigation. And just like it is for a sell, this is for a buy. It's just the same thing for a sell. Like, so if I should use this invert tool now, invert scale, and I put this upside down, now this is going to be different. All of this candle will be different now. I'm going to show you that um later. Let's just put it back to the way it was. Exactly. So this is the mitigation, and this is how to spot a mitigation candle. A mitigation candle is a candle that takes out liquidity. A mitigation candle is a candle that runs stop loss. A mitigation candle is a candle that goes below support. And this right here is a trade idea candle. So now that takes us to the next and the last thing we're going to be talking about is how to trade a mitigation candle. How then, with all this information I have provided to you, how then do you trade it? That's the most important thing. How do I make money out of this? There are two ways you can trade a mitigation candle. You either trade it at the open or trade it at the 50%. Again, when I was learning and like I was still learning and I saw these educators take the trade, I usually see them do something like this. They will measure the body of the candle from where the sell started to open to the close. All right, they will measure from the open to the close. And they used to have a fib template that says 50%. So you can see this is from the open to the close, 50% is the average. That's the half of the candle, the middle of the candle. And I will see them at times put their entry at the 50% here. And then I'm thinking to myself, okay, so maybe these institutions now that want to come back and close this position, maybe they do not want to close the trade at zero. They want to take maybe a little more profit. So they take price down the more to 50% of this candle, and then we see price reject all the way to the upside. So that way, we now have two ways we could trade a mitigation candle. You can either trade the mitigation candle at the open of the candle, or you can trade the mitigation candle at the 50%. So you can trade the mitigation candle one at the open of the candle. Number two is now what? At the 50%. Number two, at the 50% of the candle. And how do you get a 50%? I just explained it to you. You measure the open of the candle to the close. You don't have any business with the wicks from the open to the close. I've explained to you anatomy of a candle, so you should know where the open and the close is. In this case, this candle does not have an high. So in situation like this, when a candle does not have an high, what that means is the open is the same thing as the high. Okay, so you measure from the open to the close, 50% can be your entry or the open of the candle. So now, how do you trade a mitigation candle? You can trade a mitigation candle in two ways. Number one, at the open of the candle. Number two, 50% of the candle. These two areas is what I'm going to be, is what I call the entry. Okay, remember how to trade. I'm going to teach you how to trade a mitigation candle. I'm going to teach you where you put your entry. I'm going to teach you where you put your stop loss. I'm going to teach you where to put your take profit. So your entry can either be at the open, which is the start of the candle, or your entry can be at 50%. Your stop loss should go at the low or at the down range. Okay, stop loss can either be at the low of the candle or at the down range. Okay, so entry. So for entry, a mitigation candle entry can come. You can trade the mitigation candle. Your entry for a mitigation candle can, how do I put it now? Your entry for a mitigation candle can, well, there are two ways to trade an entry for the mitigation candle. Okay, number one, which I just stopped, entry at the open of the candle. Number two, entry at the 50% of the candle. That's it. That's for the entry. Now for stop loss, okay, for stop loss now, there are two areas where your stop loss, or where the stop loss can be placed trading a mitigation, candle. Number one, stop loss at the low of the candle. Number two, stop loss at the down range. That's what the stop loss. Okay, so we can put this as the entry. Stop loss is always signified as red. So we can just make this red, exactly. And then for take profit. So for take profit, we can just make this green. So for your take profit, there are two areas also, two or more actually, areas where your take profits can be placed trading a mitigation candle. Number one, remember when I taught you risk to reward? First TP, your very first take profit should be at 3 times what you're risking. So your number one TP is take profit at reward of 3 to risk of 1. Bracket RRL 1, 2, 3. That's risk to reward 1 to 3. That's where your first TP should be. Your second TP, external liquidity. Take profits at external liquidity. Number 3, take profits at imbalances or at the fill. Take profit at the fill of imbalances. Definitely. See it now? So yes, that's it. So that's your entry, stop loss, take profit. You understand? I know this video is quite long, so take your time to watch it. You don't need to rush. All right, so that's for the entry, stop loss, and the take profit. So just like it is for a buy, it's just going to be this opposite for a sell. So a sell, you're going to have a bullish candle that runs on liquidity, and then you have what the candle that sells down. You expect price to come and mitigate out. Stop loss can either be at the low, yeah. This is the low of the candle. Okay, this low. Remember, the stop loss can either be at the low of the candle, which is this low, which can also serve as the down range, right? So it could be the same place. Is that take profit 1 to 3, external liquidity, or the few of imbalances? Definitely. So this is a mitigation candle. I've explained to you how to spot a mitigation candle and then how to trade a mitigation candle. So quickly, before we move to examples, I just want to show you a couple of examples, and then I'm going to give you the homework exercise. So let me just take a screenshot of this quickly. Okay, so we have that now. All right, so now let us go to examples quickly. The first example I want to show you is on AUD card. Okay, so let's head over to AUD card quickly. All right, and then AUD card on the 1 hour time frame. So AUD card, just scale down to the 1 hour time frame. Okay, and it's on May 11th. So I've actually done searched for it already quickly, so I can just show you. So May, this is May, and then let's go to May 11th. All right, I've seen it already. Okay. Yes, look at this. Now, in this area, okay, what can we see? Although we have this liquidity, this is for later, right? Now, what we can see in this area is that the structure of the market was coming to the downside, right? Price gave us this higher high, first gave us this, I think, higher low, gave us this higher high, higher low, I think so, and then this higher high. And then price broke the structure, right? Gave us this lower low or this one low. Let's say this lower low, lower high, lower low. It broke the structure, gave us this higher high, gave us this higher low, and gave us this higher high, right? Then price broke the structure again to the downside, gave us this low, and then price went all the way to the upside, giving us a lower high, and then all the way to the downside. So from what we can see now is that price is bearish. Now, I told you a mitigation candle is a candle that runs liquidity. Now, what type of liquidity is this? This is a dynamic liquidity, right? This is a dynamic liquidity. I explained to you. Now, can you see this candle? Zoom so you can see it. Look at this big candle. This candle did what? Run all of this liquidity here. Can you see? This is the institutions. They run this liquidity. And then what? We do have a liquidity in this area. Can you see? There's another liquidity here that they have not captured. So we have liquidity to the downside in this area. So this candle itself now is what we will call this bullish candle that run the liquidity is what I usually call the mitigation candle. This is the candle that swept liquidity before price started to sell down. So this is a mitigation candle. Now, when you spot the mitigation candle, how then do you trade the mitigation candle? Because it was, I'm sorry, I'm supposed to. It's going to take us back to the front now. I'm supposed to have used the replay tool, so we don't have to. Let me just use the replay tool. Let me just cut all of this. Exactly. So now if we scale down to the 30 minutes, okay, you can see. So the candle really bought all the way to the upside. So now this itself is a mitigation candle. Now, how do you trade a mitigation candle? Told you how to trade a mitigation candle. You spot it already. You see that the structure is bearish. How then do you trade it? Remember on the checklist, the first thing is the trend. Now you know the trend. You have your top range here. You have your down range here. Now this is a mitigation candle. You can either play the open or 50%. Now this candle now take out the fib, okay, and then you measure from the open all the way to the close. And you can either buy, remember, you can buy at the open. That's the first entry. You could buy at the open, or you could buy at the 50%. Those are two entry areas. So you could buy at the open down here. After you see this break, which happened in this area, so price broke here, you could buy here as your first entry, or you could decide that you want to wait for price to come all the way up and then see if you can get a more premium entry. Now, in this case, you're playing this trade based off the mitigation candle now. And price actually broke the structure to the downside and then played. You can see how price came back into that area. So the moment this buy candle here, this one here, touches this open of this candle, that is mitigation. Institutions have closed out on that trade. So now them buying all the way more into the candle, you want to try and, book some more profits before price go down the more. Okay, so you can see. Now, if you had your entry at the 50%, you can see price came close, but did not get there. So in this case now, you would have missed out on this trade because price did not get to 50%. But now, that's for the entry. Where is the stop loss going to be? I said the stop loss can be in two areas. Stop loss can either be at the open of the candle. That means if your entry is here, stop loss has to go all the way up here. And this is a 57 pip stop loss. Definitely no. I'm not going to be trading this. A 57 pip stop loss means that my TP1 is going to be more than 150 pips. That is a lot of pips for just 1 to 3. And you see, I have to go all the way down here to make my 1 to 3 here. Price has to move. But look at, let's say we played the 50% now, and then the stop loss is at that area. We could have a minimum of 30 pips. And 30 pips means we just need to make 90 pips for our first target. Can you see what this has done to your risk to reward now? And how to catch, like how you can hit your target faster. See where this 1 to 3 was, see where this one is. So the bigger the stop loss is, the more time it's going to take for you to hit your first TP. So this is a mitigation candle. Like I said, entry can be either at the open or 50%. Stop loss can either be at the top of the candle, the eye, either be at the high or the low, depending on if you're buying or selling. So if you're buying, stop loss should be at either the low. If you are selling, stop loss should be at the high. Exactly. So stop loss was at this high here. And where's your TP going to be? First TP, 1 to 3. Second TP, look for liquidities to capture. Send now. And then your third TP, you could be playing an imbalance. That's it. So this is one example of a mitigation candle. You look for the candle, look for the liquidity sweep, measure either the open or 50%, you place your trade. After the break of structure, and then other things you're going to be learning also, like how you use the fee, buying at premium or discount, and all of that. So that is the first example. The second example is going to be AUD Chef. So let's head over to AUD Chef. On the 1 hour time frame also, AUD Chef 1 hour time frame. That was April 14. Okay, I've seen it. Exactly. So let me use the replay tool and just cut all of this away. So now I want you to look at this area, right? I already marked it out here. Can you see? This is equal highs. This is what? Resistance. This is smart money trying to induce retail traders to get in, believing that this is going to be a strong level of rejection. Price is going to sell down. People are selling this. Remember, they created this liquidity also. You can see, so this is liquidity to the downside in this area. And then there was also liquidity to the upside. Yeah. And then people are going to be selling this, believing that this is going to drop. This is a resistance. Stop loss is up here. Look at what happened. Price sold down, trapped, liquidity up, liquidity down. And then look at what happened. This candle, boom, went up, swept the liquidity. And then you can see big candles to the downside. So this is the institution now taking price all the way to the upside to sweep the liquidity. This candle now is what we call the mitigation candle. Say this is a mitigation candle. Now, how do you trade a mitigation candle? You can trade the mitigation candle in two ways. Number one, the open of the candle. Number two, 50% of the candle. And how do you get that? You measure the candle itself from the open to the close. And we need 50% open and 50%. This is the open of the candle. This is 50% of the candle here. You can either play open or play 50%. And then price created this liquidity. Price even created this bigger one here. And you see this liquidity below. And then price rallied all the way to the upside. If you wanted to play the open, you could play the open here. Stop loss, remember, should go at the high of the candle, which is in this area. Stop loss at the high of the candle, which is in this area, or can just go at the top range. So this is a 16 pip stop loss that is still fair enough. And then you can aim for 1 to 3, first TP, like I taught you, first TP, or external liquidity, which is down here, a 1 to 4. Or you could aim for imbalances. As you can see, this really moved all the way to the downside. The second way you could have gotten in, if you wanted to play 50%, you could put your entry at 50%. This one is even a more sniper entry, right? And then this is going to give you a 12 pip stop loss instead of 17 pips. And then if you got in here, this one, you're going to hit your 1 to 3 faster. Can you see? This is a 1 to 3, taking it all the way to external liquidity. For your second TP, that's a 1 to 6. And then price still sold all the way to the downside. So this is a mitigation candle. Okay. And then the last example, all of these are in the past. I want to show you a more recent one. This one, I took it on NASDAQ. NASDAQ, this was last week, price action. Just come to the indices, come straight to NASDAQ. I took the trade based off this concept. I mean, I've known this for a long time. I still use it. Okay, so this buy you're seeing that played out amazingly well. You can see this buy, this gave a really, this really moved, right? From this area to up here. Oh, I'm sorry, from like here to here. It's like a 1 to 12 weeks to reward on this trade. Isn't that amazing? Now, how did I catch this trade? Let's look at this area. Let's scale down to the 30 minutes. Or can we see? What I can see is, okay, no, 15 minutes actually. So on the 15 minutes, where is my, okay, showing now. All right, so on the 15 minutes, look at this. Just look at this precision. Price sold down, swept the liquidity. This is the institutions. Remember that illustration I showed you? Sold down, took out the liquidity, and then start to rally up. So this candle is the candle that swept this liquidity. We need the institutions are going to come back to that candle in the future to close out the position. So because I've been able to spot this candle, I can have my trade idea. Can you see? I wrote mitigation in this area and price came back there. Look at how precise this was. Price came back, tapped the mitigation, and then boom, price went up. You know what? Let me show you the chart markup so you can see that I actually saw this before it happened. Let me show you the markup. Yeah, this is it. I'm gonna show you the markup now. This, it's gonna load up. Can you see? This is what? July 11, 2023, UTC plus 2. So that was when I marked out this chart. 11. And as you can see, this is 11. So 11, this is 20 to 6:29 in the morning. This is 11. This is 6 a.m. in the morning. You can see the candle just a little bit above, a little bit past 6. Right, so this is around 6:29. So I actually saw it before it happened. As you can see, I already wrote what? Mitigation. You see, what I'm teaching you is what I'm still using. And this is the before, and this is the after. Look at how precise this was. Price came there, tapped the mitigation, and then boom, price just rejected all the way to the moon. And then after the 1 to 3, you can see we had external liquidity, and I held, and then price just bought all the way to the upside. I mean, I made quite a lot from this trade on NASDAQ last week. So yes, this is mitigation candle. If there's anything you do not understand, please go over the video again. All right, I've explained it. Just maybe you can't catch it once. Go over the video again and again and again until you understand it. And if you have any question, please feel free to send it in the question group, right? Feel free to send it in question group. And when I see it, I will attend to it. All right. So that's going to be it from, okay. Lastly, the last thing is your homework exercise. Exactly. Homework exercise. So for your homework exercise now, identify 3 examples for me of a mitigation play in the market. All right, that's it. It's a very simple assignment, not so, just identify 3 examples of a mitigation play in the market. So be it bullish or bearish, just a mitigation example. I want to be sure you understand it, just like this. Okay, including all the annotations. So I want to see all the annotations on your chart. Make sure you're marking out your structure, higher high, higher low. I want to see the mitigation candle. You can see the way I wrote it, mitigation. I want to see you write mitigation also. They want to, as I capture the liquidity, I want to see the liquidity sweep also. Make sure you show me everything. In fact, put your down range, your top range, put everything. That is the best way to learn. Okay, exactly. So yes, if you have any question, please feel free to send it in the question group. When I see it, I will attend to it. Thank you and have a good day. Bye-bye.